So there are a lot of factors that dictate whether a loan is quote unquote attractive or not. What I'll say is that if you have a cash flowing asset, that's usually the lowest hanging fruit to have the most straightforward process in obtaining a loan. And that's for obvious reasons. If there's in place cash flow, there are leases, then a bank or an insurance company or whoever the lender may be could underwrite that risk reasonably easily because they can actually look and see there's been prior performance, there's been prior cash flows, and I can project with some, margin of error what the future cash flows of that property will be and lend on that basis. So for folks that are just putting their toe in the water, that's clearly the easiest route to take. I will say that, all of us have seen a rapid increase in interest rates over the very short term. And what that translates into is that lending rates have in turn gone up. And so if you were just going to go out and buy a cash flowing asset at, let's say, a 4 cap, which is to say that the net operating income from that property relative to the purchase price is a cash yield of 4%. Well, now that interest rates are well in excess of that, it becomes a lot harder to justify buying at a 4 if you know that your interest rate on your loan is going to be 6.5. And so that business plan in of itself, I would say, lending aside, that business plan has been harder to execute. And until sellers adjust their pricing to reflect yields that are more in keeping with interest rates, it'll be hard for buyers to justify buying, even if they wanted to buy that property and get a loan. Now, what I'd say is the shadow that's cast across the whole industry is that all of that aside, the lending environment is much harder than it was. It is a lot more challenging than it was a year ago. And so there's a lot of things happening behind the scenes that you, the buyer, probably aren't thinking about. Number one, many of the loans that lenders made recently had extension options. And so given how much volatility there's been in the economy, if you had one of those loans and you were a borrower, you're probably taking advantage of that extension option. So there's a lot less payoffs happening for lenders than there would be, which means there's less capital available for them to make loans. The other thing to think about is in many cases, we think of a lender as someone that just makes a loan and holds that loan for the life of the mortgage. In many cases, they package it and sell it in the form of securities to Wall Street. But because of, again, the volatility in the markets, the pricing that they would have to sell those securities for is not accretive to them. And so in many cases, they can't sell those loans, and in turn, their balance sheets are clogged up. And so there are a lot of reasons that have prevented lenders from lending more money in this challenging environment. Banks, who are generally the most common source of funding, effectively have been under pressure from regulators to scale back their lending activity and to maintain very healthy balance sheets. So when you take that all in combination, even if you have a straightforward deal, in today's world, it is not as straightforward as just knocking on a door, getting a loan that's very attractive, walking out and getting your deal funded.
Okay, appreciate the explanation. So where do you then, Vernon, where do you guys come in this process then to, I guess, provide value to your clients?
Absolutely. So one of the biggest issues I see is that operators kind of just try to will themselves into a better situation, right? They fall in love with their deal and they say, I'm just going to call 1,000 lenders until I get the answer that I want. And we found that that's usually not a very productive exercise. So the first thing that we add value in is we help, be a second set of eyes on an individual's deals to help filter the opportunity and make sure that they're looking at it through the right point of view. The second thing we do is we give them a realistic sense of what their options should and could be given the type of deal they're pursuing and the types of lenders that are going to be the most apt to fund that type of deal and where they'll fund it. That information may inform that, wow, I'm overpaying for an asset. I need to renegotiate the purchase price. I need to change the terms of my deal. And then B, okay, great. I have a sense as to what's realistic in terms of my financing so that I can actually model how much I will realistically expect to make on my deal. That's all before you've even picked up the phone to call a lender. And if you don't do that work up front, you're going to waste a lot of your own time. From that point, the exercise is, how do we take your deal and position it? And we like to call it objection smoothing. How do we do all the objection smoothing up front so that we've taken all the risks and weaknesses of your deals, thought through reasons that the lender should not be concerned or mitigants to those risks. We've done a full kind of write-up on you to make sure that they're confident with you as an operator and your expertise, and then walking that into the right houses, the right lending shops in order to actually engage in a process to get you loan terms. And then from the point that you've actually done that process and you've gone back and forth with those lenders, and it's a dance, right? Because very seldom is it, I'm going to share that information. The lender just says, okay, wonderful, let me write you a term sheet with everything you want. Here, have it. It's a back and forth of answering questions, of helping clarify things, so that hopefully you get at least a term sheet, but hopefully multiple term sheets. And we can be in a process to work together to negotiate the best terms based off your business plan. And then at the end of all of that, the goal is that you got a loan that was well synced with your business plan and helps you, A, get a much bigger loan that you probably would have been able to convince a lender to give you before, which in turn will help you do bigger deals and make more profits down the road.